All right, guys, this is Ostibina. Welcome to Ostibina YouTube channel. My name is, uh, I'm a forex trader. So on this channel, I make content on how to trade the forex market. So if you are new to this channel, consider hitting the subscribe button, right? So that's it, guys. So on this very video, I'm going to guide you guys on. I'm going to train you guys on how to avoid getting stopped out whenever you take trade, because I've got to realize that most upcoming traders, right, they always get stopped out and then the price starts going their direction. And now this is why you get stopped out. You need to understand the fact that institutions, the hedge funds, they are the ones, right, that are in charge of this market, right? They are the ones that controls the move, each and every move of the market. They are the ones that controls it, right? So you as a retail trader, you don't have the ability to control or to move the market, right? So these the hedge funds, the institutions, the banks, right, they are the ones in charge of that, right? So what you simply do, in order for you not to get stopped out, always trade in the direction of the institutions. So you need to know the institutional order flow. Having known the institutional order flows, you know that okay, now you look for institutional reference point, and then knowing the institutional reference point, because this price, the way price moves is this. Price, the institution, they are not concerned about price going bullish forever, right? And a particular asset going bullish forever. No, that's not their concern, right? Their concern is about liquidity, is liquidity. Having enough liquidity to feed their orders. Why do you get stopped out? The reason why you get stopped out is this, right? The institutions, their orders, they have large quantities of orders to get feed, right? So and because simply because of that, they need enough liquidity to feed their orders, and then for them to have have the sufficient liquidity to feed their orders, they need our stops, right? They need our stops. So that's why you have to trade like the institutions. That's why you have to learn to follow their order flow. Whatever Wherever they are taking price to, just follow them, right? That's the first way, or the first rule, not to get stopped out whenever you take trades, right? Now, the second way not to get stopped out is this: always look for institutional reference point. Don't just buy or sell. Always buy and sell at an institutional reference point. Now, this is what the target, right? Remember, I told you earlier that institutions, they are not concerned about price going bullish forever, or a particular asset class goes bullish forever. Their major concern, or their major drive, is liquidity. So what they watch out for is taking price from one institutional reference point to the other institutional reference point, to hunt what? Liquidity, right? To hunt liquidity, to take out liquidities. That is actually what they are concerned about, right? That is it, guys. Now you can see that GU has been bullish, it has been bullish, but now you know that institution, they don't even care. It's not about GU being bullish forever, right? Yes, GU have been bullish simply because the Britain, their economy has been very good, right? These days, right? The economy has been very good. That's the reason why GU is bullish, right? This is just a reflection, right? That the Great Britain, their economy is bullish, right? So what you simply do first, know the institutional order flow, know the bada know your order flow. How do you know your order flow? You know your order flow using your higher time frame. The institution, they don't trade lower time frames, right? Know that the institution, they don't trade the lower time frame, they only use the higher time frame. So go to your higher time frame, look for the order flow. Once you know the order flow of the institution, then taking your trade in direction to the order flow. And now you don't just take your trade simply because you know the price is bullish, then you start taking you start buying the asset class. No, it's wrong. Now remember, I also said that institutions, their target is from one institutional reference point to other institutional reference point. So what you watch out for is institutional reference point. Now before taking your trade, always make sure that you are at an institutional reference point, right? Take your trade at an institutional reference point. After taking your trade at an institutional reference point, now that's because what, like I said, institution, they target an institutional reference point, right? That reference point, that's where what they are concerned about. So after getting to that reference point, what they would like to do, they would love to take out liquidity first, and after taking out liquidity, then they will now start going their intended direction. That is it, guys. That is it. First, they will manipulate it. That's why you have to take personally, for me, I recommend this before taking your trade at even that institutional reference point. You need to see a pattern like the bullish breaker or a mitigation block. Now this is how this mitigation block look like. Okay, now price has been bullish, now price has been bullish, and then price straight into a higher time frame institutional reference point. Let's say on higher time frame is an order block, right? This is an order block because another block is an institutional reference point, right? An order block is an institutional reference, though not the only institutional reference point, is actually one of the institutional reference point, right? That is it, guys. So now you know that okay, price has been bullish and price has traded into an institutional reference point. So price most times or sometimes price would love to take out liquidity from the institutional reference point with a candle wick. You say it's a candle wick and just trade higher, right, or lower. Sometimes it does, but sometimes it doesn't. So, but before taking your trade, this is what you should watch out for before taking your trade, right? So you should wait, right? Price has been bullish. You should wait for this order flow to be changed, right? This low to be changed. This is a change of character, right? You can call it a change of character. Now you wait for a character because price has been forming what? A higher high, higher low, higher high, higher low. So you wait for this to be violated, right? This to be violated to this. Once this higher low is taken, then you know that all right, the institution they are about to start trading downwards, right? That is what you watch out for, guys. That's what you should watch out for. So what you simply do after this has been taken, what you simply do, you wait for it for price to retrace, right? To retrace or reprice to a reference point as well. It can be a fair value gap, or because in this zone you will likely have an order block at this zone, right? You have an order block at this zone, and also there are sometimes you also have an order block right here, the order block right here, right? You also have an order block right here, and then there are sometimes as well there's also a block around. You see also see a block, kind of a block around this high. Sometimes price can come right here, but then if you see a fair value gap, right, pay attention to a fair value gap, because that is in most cases that's where price will get to and then start trading downwards, right? So pay attention to a fair value gap. Once price gets to a fair value gap like this, right, you take your trade to the down. That's where you take your trade. Now let me quickly show you this on the trade like I took. Personally, I'm still on the trade currently anyways. So now this is actually what I'm explaining. Let me explain that with a chart. Now this is it. This is our daily time frame. Let's go to our daily time frame. Remember I told you guys that you have to take your trade in direction to the order flow. Now what is the order flow for this? If you look at this chart clearly, you can see that this is bullish, right? The price has been bullish because price has been taking the highs, it has been taking the highs and then respecting the lows, taking the highs and then respecting the lows. So we already know that okay, the institutions they are bullish, right? So what you simply do is this: you wait. You can see this is your higher time frame, the daily time frame. As a day trader you can use your daily time frame and then go to your 4 hour time frame, right, guys? So this is our 4 hour time frame. So you can see that the highs has always been taking out liquidities from the highs and then respecting the lows, right? So that's it. So on 4 hour time frame you can see the market structure, and then look at this again. Remember I told you guys that after knowing the order flow, the next step is this: you watch out for institutional reference point. That's where institution would love to come to, right? So you look for institutional reference point. Of course this is an institutional reference point. You can see here is an order block, right? Here is an order block, right? Here is an order block. So what you simply, since this order block is an institutional reference point, what you simply do, you wait for price to trade into this institutional reference point and then go to lower time frame like 1 hour 15 minutes time frame, or yes, 1 hour 15 minutes time frame will be great, and wait for a change of character, right? Or you wait for a mitigation or breaker block to show itself. Once that happens, then you are free to take your trade. So let me just adjust all of this. So this is what I did. So this is it. So this it traded here and then this low was preserved. Now knowing that this low was preserved, it could not break this low again. Price has been coming down. It has been coming down like this. Already we know that order flow is bullish, right? So price has been coming down and then price got here, right? And then it came right here. Let's just say it came right there and failed, and then created a tried again once again, but then it failed, and then came here, and then you can see then price came and took out all of this and then came right about here, and then price came again and then started trading higher. This is actually what I love to see, right? This is actually what I love to see. Price came right there to this reference point, higher time frame institutional reference point, and then immediately price got there, price gave us a mitigation block, right? It gave us a mitigation block. Price could not take out this low, it could not take out liquidity from this low again. Instead, it took out liquidity from this high, right? This high was now taking. Remember, this is our 1 hour time frame. If you go to our 15 minutes time frame, you are going to see these things very clear, right? So it took out liquidity from this high. So after taking out liquidity above this high, remember what I told you guys, that after taking out liquidity above this high, what you should watch out for, you watch out for an order block, right? I told you guys there's going to be an order block right here. There's going to be an order block right here. There's going to, and in some cases you see an order block right up around this zone, and then there's also an order block right here. So price can also come and mitigate this very order block. So that's why your stop loss has to be below the order block, right? And then take your trade right from there and then start trading higher. I'm still on this trade, right? I actually analyzed this couple of days ago, I think last week. So that's when I did analysis. So let me quickly show you guys, so you guys know that this is not something I'm just trying to come up with us. Yeah, my GBP NZD. This is what I'm looking for, right? I think this is what I'm looking for. All right. You can see when I was planning to take this trade. Let me see. I think I took this trade, this signal earlier. I took the screenshot earlier than that. I think here, yeah. All right, you can see everything you saw right there. You can see I immediately price got to our institutional reference point. I knew that price was already at our institutional reference point, so I was waiting for price to either take out this high. Once price takes out this high, you can see just with this, and then it retest exactly the way I wanted it to be. That's how it was. Look at the time. Look, I took this around July 14th, right? July 14th. So this is how you can stop. This is how you can take your trade and then avoid getting stopped out all the time, right? So that's it, guys. Thank you guys for watching this video. Have a nice day.